My name is Tom Long. I'm with the Daily FX Education team. And if any of you had been through any of our courses, we probably have met, or any of the webinars. They work me pretty hard. That's okay. They pay me okay, too. I'm originally from the south side of Chicago, which is how I originally got into the financial markets. When I got out of the Army, the thing to do when you're on the south side of Chicago, when you take the train into town, they let you off right at the options exchange. And if you go down there and apply for a job in the winter, obviously you start off looking for a job in the financial markets. And everybody in my neighborhood worked there, and I started working at the Chicago Board of Trade. Eventually worked my way over to a bank in Chicago and became a bond trader. And I talked to a couple people here from Chicago already. Of course, there you go. Sometimes we call it Chicago, but that's all right. I got tired of the snow, ended up moving out to San Francisco, and FXCM kind of followed me out there, and I've been with them for about 5 years now. And about a year and a half ago, I migrated with about 10% of California to the state of Texas, and I work out of the Dallas area office now. It's called Plano. I like to call it Plano, Texas, but it's very nice, actually. And so I've been in the markets for about 20 years now, which makes me, what, 29, 30? But what I have in mind here in the next hour is to kind of take you through the process of how I identify trading opportunities. Okay, we're going to make it as simple as possible, because I realize that a lot of people here are new. But if I can get a show of hands, how many people here are trading live at FXCM? Okay, looks like about 3/4 of the crowd. And those of you who are not, do you have demo accounts with FXCM? If you do not have a demo account, I would recommend that you go into the next room, into the main room here, and they can get you set up before you leave. You can get a free 30-day account, and it works just like live, except for the sweating, because the money's not real. And it's very easy to wing them around when it's not real money. But then people have some issues when they put real money on the line. Even if it's 10 cents, all of a sudden the palms start sweating a little bit over a lousy 10 cents. But it happens. So a very good friend of mine, Matt Russell, who's another instructor, a phenomenal trader, is talking tomorrow about how to remove those emotions from your trading. Okay? And one of the main ways to do that, obviously, is to have an approach to trading to begin with, a very disciplined approach or consistent approach, because you want to do that over and over again. And as long as you're remaining consistent, you're not making those decisions on the fly, which are usually based on fear and greed. And for any of you that have done that, you know that usually doesn't turn out real well. Okay? So you want to identify what we're going to do before we actually get into the market. You want to identify where you're going to get out before you get into the market. And most importantly, you want to identify your risk on the trade before all of this, before you get into the market. And that's what we're going to try to do here. I kind of take this serious because I like to point out to everybody that this is speculation, meaning that the money you use to trade should be risk capital, meaning it's not the money you need for the mortgage payment or for food or anything. Okay? And I trust everybody does that, but we just like to bring that up all the time. That the fact is that most new traders who don't have a trading plan end up losing in this market. Okay? It's a well-known fact. It's not FX, it's not FXCM. I came from a futures background. It's the same thing in futures, the same thing in the stock market. That most traders new traders end up losing money. Because mostly what they do is just get in there and say, well, you know, I heard somebody said it was good to buy the euro dollar, so they buy the euro dollar, and then they watch it go against them, and watch it go against them, and watch it go against them. And eventually they're introduced to the margin watcher feature at FXCM, meaning they stayed in way too long. And the market will get them out before they end up losing more money than they had their account, which is nice, because in futures they didn't do that. Tell me, does that sound like a tough call to have to make? Yeah, you know that $10,000 account you opened up? Well, you lost that plus another $2,000 you have to send in to us right away. Those aren't fun phone calls to have to make. And so I think the FX kind of markets kind of did it right, where they set up the margin watcher feature. Some people don't like getting out, you know, without, you know, them actually making the decision. But of course, if you've gone that far, the decision, you know, has to be made by somebody. So we want to try to eliminate that in our trading altogether, obviously, because the margin watcher feature is not a money management tool, okay? Oh, by the way, we talked to the mayor of Las Vegas. What happens here at the expo in Las Vegas, you can bring home with you. So what we're going to do is a simple 4-step process here. For those of you who have been in my webinars or the courses, you know I love longer-term trading. Okay? Now, we can shorten it up a little bit to get you more active. But I think too many new traders, in spite of what you're going to hear from some other people here, too many new traders open up like a 5-minute chart to begin with, put about a dozen indicators on there, and they try to figure out whether they should be buying or selling. Okay? But I think those short-term charts, particularly the ones below the hour, winning traders at that level rely a little bit more on instinct and gut feel than they do on just the charts. Okay? And if you're new to trading, instinct and gut feel is really something you have to earn rather than just something you're just born with. Okay? So we're going to start with a longer-term approach, and we're going to identify that. And at the end, we'll talk about how to kind of shorten it up a little bit for those of you who just like to knock them around all day. You know. So we're going to start with, I'm going to open up a daily chart, and it's going to have about 1 year of trading on it. Okay? That means you can go back a year and see what the markets have been doing. I'm going to add a 200-day simple moving average, which I think is the most popular indicator in use today, particularly on the professional traders. Okay? If any of you get Investors Business Daily, you look at their charts, for the stock market, they have a 40-week moving average. Do the math. They just didn't want to call it a 200-day, I guess. I don't know. But if you see any indicator on charts from some of the experienced traders who work at the banks or whatever, you'll see a 200-day moving average on there. And we're going to use that to help identify the trend of the market. It's just kind of a reference point, because as soon as you call it up, you automatically kind of see what the trend is instead of having to do any real analysis. It just kind of jumps out at you. And step number 3 is we're going to look for the strongest trending markets. Okay? Now, I think this is key. I think this is the most important thing you can do. Okay? Picking the right currency pair to trade to begin with, I think, is more than half the battle. Okay? Because if you're picking the right market to begin with to trade, everything else you can do can fall right into place. Okay? That approach you develop to identify your entries will work more often when you're trading, if you're selling in a market that's moving down. Okay? I know it sounds simple, but for those of you who are familiar with our SSI, our Speculative Sentiment Index, you will see that most new traders, their goal is to try to pick tops and bottoms. Okay? The goal of a professional trader is to try to trade with the trend. That's where the money is. Okay? So basically, the new traders who do that are providing liquidity for the professionals. Okay? That should not be your goal in trading. Okay? Your goal in trading should be to take money from people who try to... it's funny, on all our computers at work, we have the Dell logo at the bottom. Okay? And every time it moves down to Dell, we see that more and more new traders are buying it. So we call it the Dell indicator. They're buying it, but of course the market keeps moving down. I'm going to show you some examples here. And then number 4, I know a lot of people love indicator-based trading, and that's fantastic. Okay? We're going to show how you can use your favorite technical indicator to help time your entry and identify your exit and your risk at the same time. Okay? Now, it really doesn't matter what indicator you use, because kind of one of the secrets of indicators is that they're all just really fancy moving averages. Okay? They really show you about the same thing at the same time. Some will hit extremes more often than other. But if you look, actually, I guess I should promote myself here. This is the time to do it. I'm doing a couple other workshops on basic indicators and advanced indicators, and you'll see that usually rule 1 is start with a moving average. It's always a moving average of something. Okay? Now, the reason why there are so many indicators developed is because they were developed by, number 1, money managers, and number 2, book authors, and they're used as a marketing tool. Okay? Bollinger Bands. I mean, it's just an example. That happens to be a good one, but John Bollinger is, in fact, a money manager and an author, and what better way to market yourself is to develop a new indicator and have it put on all the charting packages sitting on traders, when they pull up a chart, you'll see his name, Bollinger Bands. A lot of people don't even realize that's a real person. You think, what's a Bollinger? It's a guy. Okay? And he is an author, and he is a money manager, and obviously the fact that I'm talking about him means that he did a good job. Okay? But that's where you find most indicators. That's basically what they were developed for, is just to get somebody's name out there. Because, they don't do regular indicators anymore. They always have somebody's name on them now. John's this or Bob's that. So the first thing I'll do, and I only have to do this about a once-a-week basis, usually over the weekend, is I'm going to put this is a daily chart of the euro-US dollar. I always start with the euro dollar because I want to know what everybody's doing, because about 40% of all trades are done in this currency pair. Okay? And it's obviously by far the two largest currencies and the most dominant currencies in the world. So I always want to start with this one. And you can see that I also have my 200-day simple moving average on there. For those of you who don't know what that is, a 10-day simple moving average would be taking the closes from the 10 previous days, adding them together, dividing by 10, and plotting that number on the chart. And you do that every day, and you just connect the lines. Okay? The idea is it smooths out the noise in the market of when the market is gyrating up and down. It kind of smooths out the noise so you can kind of get a feel for really the overall trend of the market. Okay? And I'm looking for specific things. You can see at this point in time the market is moving up. It's moving up nicely. Okay? It's also above the 200-day simple moving average, and they're both moving up. Okay? That is a nice, strong, uptrending market. And we were looking for buying opportunities in this environment. Okay? I identify a buying opportunity as a pullback down to support when the market's in an uptrend. Okay? So when the market starts to pull down a little bit off the high, that is not the time to start looking for sells. That is the time to sit there and lie in wait and identify a buying opportunity. Because if the trend is intact, then it'll eventually move up through the previous high up to new highs, and that's what we look for. Okay? But that only works when the market's trending strongly. Okay? So that's our important first step. Now we can see right here where the market moved up through the 200-day moving average, came back down, and it found support and it bounced off that. We can see it again here, where the market moved down to the moving average, bounced up, and eventually it went through, and then it continued to make lower highs and lower lows. So if anybody's looking for any kind of confirmation that the big traders do use this, that's it right there. Because usually they have the deep pockets, you know. And a lot of them were getting out of any sells here, or were anticipating that moving average offering support, and they may have tried to buy there for some quick. But in fact, the market moved down through this low. Now we have a downtrend. But when the market moves down through that 200-day moving average, this is when we're starting to look for selling opportunities, and I've been doing that ever since. Okay? But the idea is not to try to convince yourself that this market is in an uptrend or a downtrend. You know, like what Matt Russell says, and you can actually do it here. He says, go to the other side of the room, turn around, and just decide, is it uptrend or downtrend? Most of them will fall into the I don't know category. And I do like to tell the story of years ago when my son, he must have been about 8 or 9, maybe 10, not quite sure. But when I was working I was doing stocks at the time, and I had the charts. This was before, you know, I probably shouldn't admit, you know, that I've been around that long. But before everybody was using computers, we used to get like Mansfield charts in the mail every weekend, okay? And you go through the paper charts and look at them, and the ones you wanted, you would update by hand during the week until you got the mailing for the next week, and then you would do that every week, and everybody would walk around with their notebooks of charts. So I was going through looking for strong uptrends or strong downtrends, or I had a bigger pile of ones that I just didn't think were really in a trading trend at all. You know, so like any kid, you know, what are you doing, Daddy? And I told him what I was doing. He said, can I play? And I said, well, interesting word, but sure, you know. So I said, go ahead and pick the ones you think are just moving straight up or moving straight down, but most of them are going to go in this pile, which means I don't know. And he was telling me, I don't know, moving up, moving down. And I started to look, and I thought, you know, this kid's good. It's my boy, you know. But before I started, you know, really getting out of hand about myself, it just dawned on me what was going on. He didn't have any preconceived notions of the market. He had no idea that they were even markets. He didn't look and say, Cisco, oh, but I read Cisco's going down, so even though it was moving straight up, that's going to go down. So, he didn't have any of that, or what we used to call dubious analysis. Okay? He just let the market itself identify, and it was just a simple approach. You know, there's that word again. You know, trading is simple, you know. But sometimes it's our own unrealistic expectations that makes it more difficult than it needs to be. And he was proof. You know, from then on, I thought, well, this is the thing to do. You know, just look for the obvious uptrends, look for the obvious downtrends, and the rest of them just don't even ignore. I mean, we're up to about more than 3 dozen currency pairs you can trade now at FXCM. That is one of our advantages, okay? And we want to use that to our advantage every time we look for a trade. Right now in the euro dollar, you know, I'm still looking for selling opportunities on that, but it's not my favorite pairs. They're coming up, though, soon enough. The dollar yen. How many people trade the dollar yen? Yeah, they gotcha. This, in my opinion, is the most difficult currency pair to trade out of all of them. I would rather trade the dollar Mexican peso than this, okay? I'm serious, too. The reason being is these are considered the two safe haven currencies. When things get weird, and people are not sure what's going on, they either move into the dollar or they move into the yen. Now, why they choose one or the other, I have no idea. I have no idea. And so you'll see people who trade the dollar yen go, where's it going? I don't know. Where's it coming from? I don't know that either. But what are you doing? Oh, I'm buying. And but that's fine. But I got to tell you, this is a very, very difficult currency pair to trade for that reason, because people who are looking to get out of not taking on more risk will go into the dollar or go into the yen, and it only matters of maybe which one's first alphabet. I have no idea why they choose one over the other. I'm sure they have their reasons, don't get me wrong. It's just that I don't know how to quantify it. So it's a very difficult pair to trade. This is definitely one of those that I don't know. It might even be one of those that I don't care, but I don't know is good enough for now. And we have the pound dollar. Now the pound dollar, obviously, we've got a race here, it seems, on the European currencies. Which ones wants to be hammered more, the British pound or the euro? And they've taken turns back and forth on which one nobody really wants. Right now it looks like it may be the euro. Nobody wants the euro, and that's fine. I'll take them. Nobody wants your euros, I'll take them, by the way. But anytime I see something like this, I know this is a downtrend. We got lower highs and lower lows. I'm always concerned about something like this when it moves up through there. And that alone will usually tell me to put this one off to the side, just in case there are some better ones that are more obvious. Because I'm looking for the easy ones. I'm cherry picking. I'm looking for the ones that might, I won't tell you how old he is now, but he's not 10. But I'm looking for the ones that a 10-year-old would say, oh, that one's going down. I don't want, you don't want to hear it, well, except for, or maybe. No, either it is or it isn't. And the dollar Swiss, again, another example on how that 200-day simple moving average is used by traders for support or resistance. And we've got a market that moved up through the 200-day simple moving average and has found some support, but this is not the kind of environment that I like to look for buys, okay? My opinion is, if the market itself is really not sure about which way it wants to go, what right do I have to think that my trade will be okay? I want to trade currencies that there's no doubt that everybody thinks this is going down. And it is going down. Okay? Because some of these markets, one of the things that people like about FX is they are long, strong, trending moves you'll see in FX. Okay, we used to see that in the stock market, but then things kind of changed. Stock market would break out and pull back down into the range. Okay? And a lot of those traders came over to FX because they would look at some charts and they go, that's what I'm looking for. That's what I'm looking for. Okay? And they've stayed. The Euro Swiss, interesting story. This is obviously a downtrend, okay? But if you look here at the 150 level, you'll see how many times the market bounced off that and moved up. You see this long candle here? That's about 400 pips in one day. You see this one here? That's a couple hundred pips in a day. We've got this one. There was somebody there that didn't want this to move down below the 150 level. Okay, as a central bank of Switzerland, okay, the Swiss National Bank. Their opinion was that if the Euro Swiss moved down through 150, Swiss exports were too high priced in the rest of Europe. So people would go look for other countries' exports. Okay? Because if you've got choices between three products of similar quality, but one's higher priced than the other, most people would choose the ones that are priced less than the most expensive one. Okay? Most people. But enough people, obviously, to hurt the bottom line of Swiss exporters into Europe. Okay? And most of their products are bought by other Europeans. So they tried to intervene here, of central bank intervention, and they tried to move the market up. They wanted to change that trend and move it up. But an indication, though, that the trend is always stronger than even central bank intervention. Eventually, when it popped through the 150 here, people were saying, okay, where's the Swiss bank? Okay, just be careful here, be careful. And it kept going down and down and down. And then even the rumors of potential Swiss bank, but these weren't rumors, these were actual, where the Swiss bank came in to buy it. You can see the markets got real crazy, okay? This is a nice downtrend, but it's also a pair that I wouldn't trade. Because all it takes is a rumor that the Swiss National Bank is coming in to stop me out of a trade. Okay, so as long as that is kind of hanging over it, I'm not going to get involved in this pair. Okay? Not many yet. Good thing there's about 3 dozen of them, though. This was my favorite currency of most of 2009, okay? This is much stronger than that euro-US dollar. I mean, this was very nice trading all in through here, okay? And we continued to look for buys until it moved down through this low, and then there were other pairs that looked much prettier than this one, okay? This is the Aussie dollar, excuse me. Yeah. And the Australian dollar, really from the lows about March 2009, has been by far the strongest currency in the world. I mean, they've been raising interest rates. And the rule about interest rates is higher interest rates usually lead to a higher currency value, while lower interest rates usually lead to a lower currency value. Okay? And since everybody else was trying to get their interest rates below zero, you know, so people would borrow and try to start the economy, they weren't having those issues, and they were raising interest rates, so everybody was going into the Australian dollar. Okay? When everybody's buying the Australian dollar, we want to be buyers too, you know. You got to be careful of that word contrarian. Okay, it's a nice thought. It looks good on TV, but we want to identify the strongest trending markets and ride the wave. The whole idea about trading is to find the strongest trending move you can find, jump on, and hang on for as long as you can. I mean, that's how I would identify trading. Okay, if you're in Chicago and you want to go to California, you don't take a train going to New York, anticipating that it's going to stop and turn around before it gets to New York. Okay, just jump on the train going in the same direction. So we want to look for strong uptrends to buy in and strong downtrends to sell in. Don't try to anticipate a major trend change. Okay? This looks a little bit better. You can see how the market's below the 200-day moving average about a year ago and has been moving down ever since. Okay? And it's been below the 200-day simple moving average since that time. Okay, I mean, it's obviously moving down. It's not moving down as strong as I like to see, but the fact is that there are a lot of selling opportunities on this pair. None that I really got involved in, you know, because there are other couple of currency pairs. I know they're coming. I wrote this thing that are coming along that were much better than this one. The Kiwi dollar. In New Zealand, they are a very similar situation to Australia. They weren't raising their rates as aggressively, so but back through here, this is a great uptrend. This is where you want to look for buying opportunities. When you see this, you want to avoid it. Okay, the market itself doesn't know which way to go. But here's another indication too of how important that 200-day simple moving average is. How it kind of hugged it all the way up. You know, that's not a coincidence. You know, those are big traders knowing that the market, there's really nothing that's going to push this market down into a downtrend. You know, so they were using this as places to buy. By the way, I like to keep these workshops kind of informal, so if anybody has a question, just go ahead and raise your hand and ask right at that time, because obviously this is a big room. There are probably about 15 other people wondering the same thing. So I just want to make sure I don't skip anything or kind of leave you hanging on something I'm talking about. Here's the euro pound, what I was talking about. This is the race to see which currency can be weaker than the other. And it looks like it's pretty, you know, that moving average is moving sideways. You know, I have no idea. You know, I have no idea. I wouldn't be buying either one of these, though. These charts are only about about a week old, maybe 10 days at the most. And nothing's really changed, you know, since I put this together. The euro-yen. Again, the one thing that we want to see, that we're seeing in common here, is that the euro is weak again. The euro is weak, the pound is weak. Every time we called up the euro or the pound, you know, they're in downtrends. Okay? So we obviously don't want to be looking for buying opportunities on the euro or the pound right now. You know, but this is just a range-bound market. It's below the 200-day moving average, but this is not exactly the kind of market that we want to be looking for selling opportunities in. You know, there are much better ones. Now, these pairs for a long time were favorites for carry traders. Everybody know what the carry trade is? You know, at the, see, I'm in my own time zone now, so I can say 2 p.m. close, right? But it's really 5 p.m. Eastern. You know, there's a rollover event on whether you're credited or debited rollover, which is interest, on a daily basis. So carry traders are longer-term traders who look to earn interest on a daily basis, because it's usually those currency pairs that are paying the most interest that are in the strongest trends, because long-term carry traders carry a big stick in this market, okay? They are some of the biggest traders in the market. If you talk, people talk about George Soros being a currency trader, or a lot of those big traders. They were all carry traders. Okay, they were simply looking to earn interest, and the more interest they can earn, the better. And because everybody was looking in to earn interest, those were usually the strongest trending markets. And we actually there are a couple examples today, a pretty good one. But right now, that is not. And we have the Swiss yen. See, none of these yen pairs, they're just really moving sideways because there's been strength in the Japanese yen because people are going into the yen to kind of avoid going in any other currencies. Okay? So they've really kind of taken away any of the trading opportunities that we saw maybe 2006, 2007. My favorite. Did it kind of jump out at you? It's like one of those eye tests. This is the Euro Aussie. The weakest currency right now is the euro. The strongest currency is the Australian dollar. When we want to look for trading opportunities, we want to match up the weakest with the strongest. And this is it right now. I mean, it's been below the 200-day moving average for the whole year. Just a series of lower highs and lower lows. Those are stair steps that I could go walk down without falling. It's got the separation and the 200-day moving average. They're both moving down at the same time, and it really doesn't get any better than this. For those of you who have been following anything that, we do columns on the Daily FX Forum every day. We've been following this one for a year now. Is every time it moves up, we look for selling opportunities. And I would continue to do that now. Matter of fact, I may be missing one today. I think there's another pair here where the euro gained a little bit of strength last week, but I think it gave it all back, with the opening today. So may have missed another trade, but that's all right. Yeah, there will be more. And this thing has been trending down for... Actually, this right here is a 13-year low. That'll give you an idea of how long these trends can last. Okay, if you would look at my trading record, you'll find that probably half the trades have been in this pair alone. Okay, I've just been selling it and selling it and selling it. Anytime it moves up to a resistance level, as we'll see here, we're going to show how you can use indicators to time your entry on this. We've just been doing it. Every trade won't be a winner. Okay. But when you're trading with the momentum of the market, there's a lot more room for error. You don't have to be exact in your entry and your exit to have consistently profitable trades. The momentum of the market will help you with some of those errors where you got in too early, you think you got in too late. But the momentum of the market will be your best friend. Some say the trend is your friend. I don't know. But it's the same thing. Okay? That's what they mean. Okay? They mean that if you have identified your risk, and as long as you can stay in the trade, it's the momentum that will carry you into profitable territory. And it really doesn't get any better than this. And there are always about 3 or 4 currencies doing this. Okay, that's what's great about FX. There are always a few of them. I mean, that are so obvious. This would be one. Obviously, my son would have been all over this one. Oh, this is an easy one. Okay, make a mental note. He said it was an easy one. Yes, sir.
Say you're going to do a buy today.
Mm-hmm.
Oh. Do it at the 200 day?
Did you really say if I'm going to do a buy today? I couldn't resist because you told me you were going to heckle me, so I saw an opportunity to get you back. I'm going to get into that actually, on how I do that using indicators. I'm going to show you, and I'm going to show you how with indicators you can identify your not only your stop loss point but also your entry. Yeah, absolutely. I'm going to get into that in a minute here. I also want to keep track of time. I don't wear a watch anymore. Ever since they came out with these fancy phones, I just don't. Here's another one. Actually, I think this one was probably a better trade on, because I think this one moved up a little bit more on Friday and may have moved down a little bit more. Okay, I can get quotes, but you really can't get too many charts on the iPhone yet. But this is another one from the highs in December down to here. I mean, this is almost what I call a parabolic move. So as soon as the market moved down through these lows, we started looking for selling opportunities on this. And whichever one set up first, I'd take it. And then when I'd finish that one, the other one would set up. I'd take that. So I would think about, since the beginning, since about this time here, about 1/3 of my trades have probably been on this currency pair at the same time. Okay? And it's been a lot of fun. This is the Euro CAD. I'm sorry. Thank you. I know it's very difficult to see back there, I'm sure. Yeah, this is the Euro CAD. Again, the euro is just getting hammered. All we have to do is find the strongest currencies and match it up with the euro. Yes, sir? No, not all of them. Sometimes, like in this situation, the question was, are all my entries and exits on the daily chart? And no, they are not. And I'll cover that in a minute. But sometimes when you don't see that move up to resistance, I move down to the 4-hour chart, and I'll look to kind of get trades in between these big moves on here. And I'll show you an example before we, on this PowerPoint presentation. But I've got the Euro Aussie and the Euro CAD right now. Definitely go into that pile of strong trending moves. And those are pairs that I want to hold on to the side. Okay? Now the Aussie CAD, again, this looks like almost like the Kiwi dollar, doesn't it? How it kind of sitting there on the 200-day moving average and just kind of moving sideways. And obviously, this is not the kind of environment where I'm looking for a trade. Now the Aussie yen, well, that Australian dollar has just been nice. And that's good. Obviously, it's moved up. It's the highest it's been in a year. It's not really as pretty as the Euro Aussie. And like I said, I am a bona fide cherry picker. I will pick the most obvious ones because those are the environments that I want to be risking my money in. And when I'm looking at the Euro Aussie or I'm looking at this, I'm picking the Euro Aussie 10 out of 10 times, or the Euro CAD. The pound Aussie. Okay, right now the euro is a little bit weaker. For some reason, we got elections going on in the UK, and I think that's kind of affecting, kind of giving a little bit of strength to the British pound. So we can see that it really hasn't been moving down to the lows like we saw the euros. The euro's got no problem moving down to the lows, even though there are elections in Germany. I think they're a little bit more minor in nature rather than the major elections in the UK. So until that kind of gets settled, the British pound seems to be moving sideways right now. And if you're moving sideways against the Australian dollar, that means you've got a little bit of strength going on. The Aussie Kiwi, I actually trade this. It was actually one time where this was the only currency pair that was in a trending move. And so I had no problem. I was trading this one at the same time. But usually what I'll use this one, if I'm looking like at the Euro Aussie and I'm looking at the Euro Kiwi to see which one's in a stronger downtrend, that's when I'll use these pairs. This is the Aussie Kiwi, and I'll see which one is stronger. Because obviously right now the Australian dollar is stronger than the Kiwi, so I would rather trade the Euro Aussie than the Euro Kiwi. Okay? Does everybody kind of understand what I mean by that? It's just relative strength. That's all I'm looking for. I'm looking for the strongest currency, I'm looking for the weakest currency, and I'm looking to trade that pair. Yes, sir?
You would buy long on the Aussie versus the Kiwi, just looking at this trend.
Yeah, I mean, this is an uptrend. I would do it. I think there are better trends, but, this is obviously an uptrend. Yeah. Yeah. That's not me. I don't know that song. The pound Kiwi. Again, we have a similar situation. The pound Aussie looks better, but right now the British pound's got a little bit of strength. The euro has no such issue. We have no idea how far the euro is going to fall. We have no idea what's going to be going on with Greece. We have no idea what's behind Greece. Now we're starting to talk about Spain. We're downgrading countries now. We've done that more, I think, in the last couple of weeks, and I think I've seen, in my time in the markets, and they're all European countries that are in the Eurozone. Okay, so there's some serious issues, and certainly we have many states that have serious issues too, like California. But we know California's not going to leave the U.S. And there's a much closer bond than maybe Greece and the Eurozone. The Eurozone is kind of new. It's only been around, about 10 years, 11 years? So there's a lot of uncertainty right now with the Euro and with the Eurozone. And you see it reflected in the charts where really nobody wants to own the Euro right now. They would rather own other currencies. So if you have Euros and you don't want them, you want other currencies, what do? You sell the Euro, you buy the other currency. And everybody's been doing it pretty much at the same time. Since December, there's been another new level of selling the Euro. My favorite uptrend, the Aussie Swiss. This is my third one, the third of my favorites, and you can see the same thing. It's above the 200-day moving average. We just see a series of higher highs and higher lows. It looks like a nice stair steps up to the top level of trading, or whatever you want to call it. And every time this market has moved down, we've been looking for buying opportunities on this. Okay, so I would definitely be putting this one in the same category as the Euro Aussie and the Euro CAD. Okay? This I think I had third. I had of this last week. When I usually do them in the Daily FX forum, we have the instructor trading tips, and I have the chart of the day, and I will go through there, and I'll start on Monday with what I think is the strongest trending move, and then on Tuesday I'll do the second and the third one, and it also shows up on the Daily FX site. So if you're looking for a little bit of help, you could pick one. You can always come to the site on Daily FX, the forum, and check out to see what we think, because we'll always talk about what we think are the strong trending markets. Okay, and this was the third. I think I had the Euro Aussie first. It's been first for a long time, and it will be first until it dramatically changes. The Euro CAD second, and the Aussie Swiss. But for some people who prefer buying than selling, you can't go wrong with any of those three pairs. Okay, if you prefer buying, go ahead and look for buys on the Aussie Swiss. Okay, I have no preference whether I'm buying or selling. I'm looking for profitable trades, and I just want to go in the direction that the market wants to go in. And like I said, just jump in, hang on, and ride it for as long as I can. Technical indicators. Yes, sir.
Good question. You're following a trend,
Yeah.
right? And at what point do you start to think the trend is reversing?
It takes a long, long time to do that. Let me go back one. Yeah, it's at what point, obviously the trends last for a long time, but at what point do you decide that the trend has changed? Okay? When the market moves down, like through this low, I'm looking for the stair steps up. Okay? Now, there's really no rule on how to identify that. But obviously, I'm looking for above the moving average for an uptrend, and I'm looking for a series of higher highs and higher lows. Like right now, if this market were to move down through this low, then I would look elsewhere for a trade. Okay? And remember that, it's really relative. So all you do is look at it, and you can decide which one you think is the strongest. Okay? But for an uptrend, I'm looking for higher highs and higher lows. On a downtrend, I'm looking for lower highs and lower lows. And on a downtrend, when the market moves up through the previous low, then it goes into the I don't know category until it moves down to make a new low again. Okay? But as long as that high is lower than the previous high, to me that's a selling opportunity and not, a reason to get out of the pair. Yes, sir. There? Yeah, that's nice. Yeah, on March 1st. Yeah. I'll show you that in a second. We're gonna move down, and I'll show you what I do. Okay, did everybody hear the question? You're talking about when to get in and when to get out, and that's why I said you identify the strongest trends. You have a nice, consistent approach to identify your entries and exits. You use strong money management, and you should still expect to lose half of your trades. Okay, you should still expect to lose half of them. You can't be a profitable trader until you learn how to lose gracefully. Okay. I like to talk about the movie The Good Year. I don't know if anybody ever saw it. Russell Crowe's a big bond trader in London. And he's growing up with his uncle, who's Albert Finney. And he's teaching him about, you realize he's teaching about trading if you look at it from a trading point of view. And one of his lines was, losing is inevitable. The trick is not to make a habit of it. Drink, well, he said, that's got nothing to do with trading, but that's kind of a cute add-on. Yes, sir? No, we're going to go down to the 4-hour. The question is, do I swing trade? Meaning, what you're looking for is a strong trending moves, and we're going to move down to the 4-hour chart to look for the swings between the highs and the lows, which is going to get into what we're talking about, on where to get in and to get out. That's called swing trading, and it starts with identifying the strongest trending moves, and then pop down to the 4-hour chart and look for trades in the direction of the trend on the daily chart. Okay? But if I see the trade setting up on the daily, I will take that. Because that's where you're going to find where you're in on those 1,000-pip moves on the daily chart. Okay? And there's nothing better than trading and being in a trade for 6 weeks. Wake up in the morning and checking the chart and see you've made another, 50, 60, 75 bucks. Very nice. Yes, sir. On your swing, if it doesn't take you out, pyramid? No. I will tell you what let me wait until let me answer that as I get down to, because in a way I do pyramid, but I'll do it a little bit differently. Okay, so let's go to the Bollinger Bands. If anybody uses Bollinger Bands, you know that you start to look for a trade when it hits the bands, okay? but we've got a directional bias. You see how many times it hits the bands on the bottom in a downtrend? I mean, you can just get chewed up, you know. But look how many times it hits the bands, the top band in a downtrend. It's at that point in time when that sets up a potential selling opportunity when we're using the Bollinger Bands, okay? At this point in time, I would like to go down to the 4-hour chart to pinpoint that entry and exit, and I'll show you some of the ways I do that here in a minute. But this is just an example of how you use your indicator to identify trades. It's when it gets into this area, if you start looking for selling opportunities, you can see that there's an opportunity to have some nice trades in there as long as you kind of tighten up your method of entering the trade, okay? But again, the key is the strongest trend, trading in the direction of the trend, okay? Technical indicators will only show you changing momentum. Changing momentum really doesn't mean anything. But if we're in the Euro Aussie and we see a rally up to resistance, and then we start seeing changing momentum, the odds of a full board reversal are a lot better than if you're trading against a trend, okay? And here's the Euro, or the Aussie Swiss, just to show what some buying opportunities look like. You know, we can see the same thing as how many times it touched the bottom, and we can see some nice big moves off of that. So see, I would have been in the trade before February 25th. One of my personal favorite indicators is slow stochastics. It really just kind of shows you where the entry is right there in front of your face, okay? That's just my preference. You know, I've had people tell me, you know, Tom, I've looked at slow stochastics on your recommendation. I don't understand it. RSI makes sense to me. What do I do? Well, use RSI, not slow stochastics. I mean, they're really telling you similar things. But basically, for selling opportunities for slow stochastics is when the slow stochastics and the moving average. I use, by the way, I'm showing here a 14, 3, and 3 value for my slow stochastics, okay? I will use 14, 3, and 3 or 15, 5, and 5. Doesn't matter. I come from a futures background, and the default setting is usually 14, 3, and 3. When I moved over to FX, it was like 5, 5, and 5, or 5, 3, and 3, and it's just way too fast. I like to slow the signals down because I want more reliable signals, okay? I don't need a lot of trades. I need profitable trades, okay? So basically, you can see right here where it really picked nicely these peaks, okay? This one was close but didn't make it. But again, we started off with a directional bias. We chose the right market to begin with, and then we're just popping on our indicator to help us identify our entries. This one was a little bit more active, but I'm looking at, you know, as many pairs as I can, usually about 3 or 4. And you can see there were quite a few more buys. The buy is when it moves below the 20 slow stochastics, crosses over, and starts moving back up. Any questions, sir? Yeah, when you call up slow stochastics, they'll have the values on there, okay? The 14 is the raw stochastics, okay, which really just measures where the market's closed depending on the range. The idea is, in an uptrend, the market will close near the high of the day. Okay, in a downtrend, the market will close near the low of the day. Stochastics measures that. As we get into the moving average, the second 3 is a 3-period moving average of the raw stochastics. The second 3 is a 3-period moving average of the 3-period moving average. Okay? Yeah, the second 3. Yeah, the third number. So these two lines are just basically both moving averages of slow stochastics. Okay? It just filters out a lot of the noise. It kind of gives you a little bit more accurate signals, more reliable. I prefer. But again, the key is that we were trading the right currency pair to begin with, and we had our directional bias to work on. This is, let's take a little bit closer look at this. Using slow stochastics, the actual sell is after you've confirmed the crossover. Okay? That means that I wait until the candle's closed. Okay? Because it can cross over during the session, but at the end of the session, you can see the market will rally and it won't be crossed over at night. And I don't want to get in early. Yes, sir? Well, I didn't hear the whole question, but the first part I said is slow stochastics more reliable than any. It really isn't more reliable than anything. For me, it's just a personal preference. Okay? I'm sorry? Absolutely. Absolutely. I don't buy that markets range 80% of the time, that you should be range traders. I don't buy it. By the time I can identify a range, it seems to be over. You know? And so I just don't buy into that, look for the ranges. I look for the strong trending moves. You know, I was very lucky, you know, when I was in Chicago, I learned from traders who have been in the business for 30 or 40 years. You've been in the business that long when you know what you're doing, you know. And I would say stuff like that, and they would hit me in the back of the head and say, don't say that again, you know. But you learn, because you don't, you know, they didn't really hit me. But they would say, a range-bound market means people don't know really which way it's going. You're depending on them all to decide that's far enough. That doesn't seem right, you know. They said we would just look for the strongest trending moves. Yes, sir? Well, I'm actually doing some indicator workshops later on, and RSI I have an issue with. It just doesn't seem to show enough signals to get into a trade, which is why I prefer slow stochastics, because it does seem to offer enough signals to get into the trade. But for some people who prefer RSI, that's fine. I mean, you're really doing the same thing. Well, the 14 setting, you know, I have an issue with that. I think you got to bring it down to, you know, 10 or 11 in order to get some signals. And I worry about, you know, speeding up an indicator. I like to slow them down, you know. So it kind of works against my feelings about using the RSI itself. So really, I don't use it, you know, but that doesn't mean that it's not worthy. You know, for people who do like it and understand it and can make it work for them, that's fine. It really doesn't matter what indicator you use. Well, ADX is, you know, not an indicator that would help you time your entry, you know. So I would use it, but not to help me identify my actual entry on the trade. I prefer the oscillators, you know, the RSI, MACD, stochastics, to actually identify an entry point. Yes? Pardon me? I've got them. It'll be in the basic indicator workshop. I'll be talking about the MACD. I think that's today or tomorrow. I'm not sure yet. Yes, sir, a question back here? What, the divergence? Yeah, well, right here? Yeah, divergence is when, see, the price is making a lower low, but the stochastics is making a higher low. I would use divergence, but again, only in the direction of the trend. You know, I just think that the direction of the trend is by far the most important piece of information we can use in technical analysis. Start with that and work off it, and sometimes you'll be surprised on how everything else can fall into place. Okay, but it really is that important. I know Matt Russell and I kind of have arguments, which is most important, you know. I say it's the trend. He says it's money management. But to me, money management is the second most important thing. To him, it's the trend. So basically, we're agreeing. We're just kind of agreeing to disagreeing, which is more important. But by far, those are the two main things that most successful traders have in common. They trade with the trend, and they are just really big on money management. Yes, sir?
Could you explain this chart? Because I'm a little bit confused.
Sure. Yeah, let me jump into it then. We're looking for this crossover to actually be confirmed, and that only happens at the end of the session when the candle closes and it starts moving on to a new candle. The one nice thing about using the daily chart, that means you only have to check it once a day to see if you get in. That's 2 p.m. California, 5 p.m. Eastern. Because it's at that point in time where it's either going to be crossed or it's not. Okay? So for those of you who are looking to trade and don't have time all day, using an end-of-day approach like this could fit in nicely with your schedule. Okay? All you have to do is check it at the close. Okay? Or if you're an hour after the close, go ahead and check it an hour after. Okay? But the entry is actually at the open of the next candle. Now, you see this candle here is actually when the crossover took place. Okay? And so the entry was right here at the next candle. Okay? What I'm doing automatically is my protective stop goes above here. Because obviously I'm looking for it to move down to new lows. If this market reverses and moves back up through that high, something's changed. Okay? It's probably going to be a news item or something, or central bank, president's going to say something, and I'll call them names, and and I'll lick my wounds. But that's why you can only expect to win half the trades. If there was absolutely no news at all that came out, trading would be a lot easier, But it doesn't quite work that way, So if the market were to move back above this high after I've identified the reversal, I want to be out, so I know where my stop is. Okay, and in this case, the stop is going to be, I've got this candle here, it's at 181.037. We're using fractional pips now. And my entry is going to be at the open, or the close, because I think I've got this candle listed. So it's going to be at 178.40. So I know how much I'm risking. The difference between my entry at 178.40 and my stop at 181.04, or whatever I want to use. I just use about a pip higher. You know, there's no need to do 10 or 15. I don't care. You know, if you do 10 or 15 pips higher, or if your entry, you wait for 10 or 15 pips. That's 10 or 15 pips you lose on every trade. You know, so I just use 1 pip or 1 plus. You know, with fractional pips now, I probably would do 181.05. And by the way, I would also switch my chart to the ask, okay, the offer side, because that's the buy side price, right? Everybody knows that. The B is the bid side, that's the price you can sell it at. But there's a spread involved in FX. If I'm looking to put in a protective buy stop, I need to click on that button, and it'll tell me the buy side high. Because if I'm selling, my protective stop is a buy, right? Because I buy to get out of my sell. People you with me on that one? Okay, I want to make sure that's kind of important. So I know what my risk is. Now what I like to do is what they call work a trade. If the market continues to move down, I'll move my stop down with it. Okay? But it's a very difficult thing to teach people. So we teach just to use a simple 1 to 2 risk-reward ratio. Okay? If I'm risking, say it's 250 pips, it'll be nice to me. If I'm risking 250 pips, I look for 500 pips in profit. And I will go ahead and put my limit order in for 500 pips right there, because I'm not going to be watching the market all the time. I don't want it to hit that 500 and then bounce back up and stay there for a week wondering why didn't I put in a limit order. So I'll put in a limit order there. I'm risking 250 pips. I'm looking for 500 pips in profit. Because if I'm expecting to lose half my trades, I have to make more when I'm right than I lose when I'm wrong. I can look for twice as many because I'm trading in the direction of the trend. And that momentum will help me out. If you look at a trending move on a daily chart, a lot of times you'll see a 1,000 pip trending move, a 500 pip move against a trend, a 1,000 pip trending move, a 500 pip move against a trend. That's what a trending market does. Okay? So trading with the trend not only helps me because I'm trading with the momentum of the market, but allows me to look for twice as much in reward that I'm willing to risk on the trade. Okay? And I never, ever, ever get in the trade without first identifying my risk. People usually ask me, what's the difference between an experienced, professional, profitable trader and a new trader? The professional trader is always identifying and trying to limit their risk on every trade. A new trader is thinking about how much money they can make and how quickly they can quit their day job. Okay? It's no coincidence that professionals make money and most new traders have a tough time getting to that profitable stage. Okay? So we want to identify the risk. If you have sports fans, you ever heard the cliche, defense wins championships? It's the same thing in trading. Okay? Identifying and you're limiting your risk. If you ever take the elevators at the Chicago Board of Trade, I used to work there, or even at the bank coming from the trading rooms, they're not talking about where they're looking for the market to go. They're talking about how much they're risking on the trade. It's really kind of it's a strange thing. You think, well, how do these guys make money? Well, trust me, they do. Okay? But they're always, that's why Matt thinks it's money management, and it's a valid point too. But we always want to identify the risk. There's another step I'll take to get into your question. If the market moves halfway to my target, I will move that protective stop down to break even. Okay? Because at that point, one of two things can happen. I can get the 500 pips in profit, or I can break even. But more importantly, I never risk more than 5% of my account balance at any one time. Okay? So if I get into this trade, this is the only trade I'm in, because I'm risking, if I have a $10,000 account, obviously I'm risking $500. If it's $1 a pip, I can open up 2 lots, okay, because that's about $500. Assuming this is $1, I think it's actually a little bit less than $1, but it would still only be 2 lots. There's not enough room to get 3 in there and keep that risk below 5%. But when I move that stop to break even, then I can look into another trading opportunity and risk that 5% on a second trade. That's how I'll pyramid into positions. When the markets are trending strongly, you can find yourself in 3 trades at the same time, but you're still only risking 5% of your account balance at that time. Okay? That's more of a way to professional approaches the markets. Okay? That's what's called limiting your risk and really looking for some nice reward. Okay? But that's how I pyramid. I won't go into the same currency pair, but obviously if I've got 3 or 4 trending pairs that I'm looking at and there's another trade setting up, if I can get that stop, if it's moved down to break even, I can open up a second trade. Okay? Does that answer the question? Good. The Aussie Swiss, it's the same thing. We can see the crossover here. I think it was at this candle, but my entry is at the opening of this candle, and I place my stop below the low. Okay, we can see it right here. The close, my entry is going to be at about 91.75, and the low is going to be about 91.20. It's probably a little bit lower. I think this candle might be a little bit lower, about 91.20. So this is a lower risk trade. Okay, but I would still open up enough lots to risk 5% of my account and balance, because I'm looking for 10% when I'm right, if I get that full reward that I'm looking for. Okay, so if I'm risking 75 pips on this trade, I'm looking for 150 pips in profit. I will put those in right away, and I will also, if it goes 75 pips or halfway to the target, I'll move that stop to break even. And then, hopefully it happens. What I really would love, in a perfect world, you'd move the stop to break even, and the next day a new trade would open up, and you just keep doing that. It doesn't always work that way. There are many times when I'm in no trades at all. It's not a lot of fun, but I have a demo account for fun. If I need fun, I open up the demo account, and I can whip them around in there like there's no tomorrow. Yeah, the demo account, I'm underwater on my demo account, by the way, which just kind of shows that while it's a lot of fun, I'm in the market. I'm not looking for excitement. I'm looking for profits. But I have a demo account for excitement. I'll try day trading and all kinds of stuff. So again, to look over the 4 points, this is what we're doing. I'm starting with the daily chart with 1 year of trading. I'm putting the moving average on there to help me identify the trend. Looking for the strongest trending markets, and I'm using my indicator to help me identify my entry. I buy and sell at the open of the next candle after the signal. I place my stop above the high or below the low to determine my risk. I look to take profit at twice that risk for a 1-to-2 risk-reward ratio. I will leave this up for a minute. And I limit my total risk to 5% of my account and balance at any one time. Okay? So when I get back on Wednesday, first thing I'm going to do is call up the Euro Aussie, the Euro CAD, the Aussie Swiss, and the Euro Dollar and see what's going on. I'm going to look for, hopefully, if I missed a trade, well, then I missed a trade. But I'll be looking for the next setups and only those 4 currency pairs. Because on the daily chart, the trends don't change all that often, right? I mean, it takes a while. It takes a couple of months for a trend to change. Let me go to this next group real quick because we're getting close to, and I will put this back up for you. If nothing is setting up on the daily charts, it's okay to move down to the 4-hour chart. Those are called the dealer's charts. A lot of dealers will trade off of the 4-hour charts. And I will do the same thing. I'd open up a 4-hour chart with about 40 days of trading. It's about 2 months. I add the 200 period simple moving average because it's not a daily chart, so it's not a 200-day moving average. Again, I look for the strongest trending markets, and I use my favorite indicator to time my entry. I really prefer it. I will not trade on a 4-hour chart. I will only trade in the direction of the trend on a daily chart. So quite often, it's the pairs that I'm looking at, the Euro Aussie. And you can see on the 4-hour chart, we identified a lot of trading opportunities. But the one thing you're going to have to accept, technical analysis is not as reliable on the shorter term charts. The shorter term it gets, the less reliable it's going to be. On a 1-minute chart, sometimes it's just crazy to put any indicators on there. They don't do a whole lot. You really have to be a lot more flexible. Okay, so you can see right here that here's the crossover, and if you get in here, that maybe I got stopped out here. I would have gotten in again, but I would have gotten stopped out there. You just have to be willing to accept more trades, but less reliable trades when you go down to the intraday charts. Okay, and the 4-hour chart would be my choice. But you can do that if there's nothing setting up on the daily chart. Move down to the 4-hour charts to see if there's anything setting up. Okay, it's still a very reliable time frame to use. Just not as good as the daily.